Hello and welcome to Money Control Special on Managing Market Turns. My guest today is Rajesh Bhatia, who manages ITI Long Short Equity Fund. We have very few long short equity funds in India, and obviously it's a distinctly advantageous portfolio strategy to follow, especially while navigating turns in markets. Thank you so much, Rajesh, for joining me for this discussion today.
Thank you for having me.
So let me just dive into the kind of fund you manage, and can you just elaborate on your strategy? I just know that you have a strategic portfolio and a tactical portfolio, and you go net long up to 80% in a bullish market, about 20% in a bearish market, and somewhere in between in normal markets. But tell me more about your approach.
Sure. So just let me just step back. So ITI Long Short Equity Fund is really a fundamental long short equity product. This is really an alternate way to invest in the equity markets. You want to be in equities because this is the best asset class it has been in India and also in, let's say, the United States.
Right.
For 42 years, India has compounded at 16% in equities. That's a phenomenal level of wealth creation that has happened. Having said that, there is also volatility associated with this asset class. Let me give you an example of 2008, when the markets contracted by 55%. Now, it took 6 or 7 years for even your principal to come back, which means that's a lost decade of returns. You know, one investment principle which one must keep in mind is to have an attractive rate of compounding over long periods of time. It is necessary to prevent downside.
Correct.
Right? So in India itself and abroad, there are a variety of long short equity funds. By the way, this is a $4 trillion market globally. Compare that to a $5 trillion active mutual fund market in the US.
Right.
So that's how big this is. But in India, it's really at the ground floor.
Right.
There are many types of long short equity funds, but this is what we do. We, from a value add perspective, we try to achieve a asymmetric return profile. So what does that mean? When markets decline, we make sure or we try and achieve a decline, shorter decline to the markets, and vice versa, which is, you know, when markets go up, we try to participate in the equity-like format, right? Which means that over a full equity cycle, as markets go up and markets go down, we are able to beat the markets with much lower risk and much lower volatility. That is really what is the objective of our long short equity product. You know, as far as our approach is concerned, like I said, you know, we are a fundamental long short equity product. If I were to nutshell our philosophy, I would say risk return is an extremely important component of how we approach equities. So my experience is the best returns are made not only when you get your EPS growth right, but there is also an PE expansion.
Right.
Those are the stocks which actually give you the best return. So risk return is the most important thing for us, and our preference generally has been towards predictable multi-year growth opportunities.
Right.
So that's really you'll see a bulk of our long portfolio in.
Right.
So that's really a nutshell of you know, how we approach equity markets.
Right. Is there a particular strategy to the short side?
So, you know, by the way, I would say that it's a very important component of investing, I would say, especially in these times. So why do I say that? You know, if a lot of experts would tell you that this is the phase of the largest technology transition that businesses are ever seeing in the history of humankind.
Right.
So what we are seeing is a lot of businesses are getting disrupted, right? So how do you value a company? It's basically the net present value of free cash flows till eternity.
Sure.
Now, if you have ever done a net present value, you would realize that the later on cash flows, right, the terminal value, has a large impact on your net present value.
Right.
Now, when businesses get disrupted, right, the market assesses that the future cash flows are going to get impacted.
Right.
So we are seeing a lot of derating of such businesses.
Correct.
Now, you can see that in the automobile business, electric vehicles are trying to disrupt automobiles.
Right.
Tesla's market cap is greater than the top 10 IC engine manufacturers, right? When you see broadcasting yourself, you can see Facebook, YouTube, OTT platforms disrupting some of the advertising that broadcasting is getting. Even gas distribution, right? is getting disrupted because with the adoption of electric vehicles. So there are a lot of businesses which are getting disrupted, and as a fundamental analyst, I have an opportunity to short some of these businesses. Apart from that, there are cyclical opportunities, and there are companies with high cost structure, over leveraged opportunities that we can short.
Sure.
One thing that you have to keep in mind, and that's a part of my learning as far as shorting is concerned, is markets take steps to go up, but it is the escalator
to go down.
to kind of go down. So one learning is that whenever that escalator phase comes, you need to double up on your short positions.
Sure.
So there is a significant value add that you can provide to an investor by having this short book and as a fundamental analyst.
Sure. So I'm going to dig a little deeper into the shorting strategies,
Sure,
because that's really relevant in this market.
Sure.
But before that, you talked about the 2000 fall, right? And
Yeah.
it took many years for the market to come back to that
Sure.
level. 94, it was again the same. 2008, of course, was shorter because
Sure.
of the liquidity injection, etc. So tell us more about your experience at that time, and what was your strategy? What were your key learnings from those two episodes? What were the signals at that time that sort of made you switch? And I presume you were in a long only fund at that time. You didn't have a long short fund at that time.
I did, by the way.
Okay. So in which case, please elaborate.
So I was in a long only fund when the phase was going up, 2003 to 2007.
Right.
I set up a long short equity fund auspiciously in Jan 2008, the peak of the market.
Okay.
So what was, if you kind of step back and think about that phase 2003 to 2008, we started with a price earnings of 8 times for the market. The market was significantly cheap. It's possible that we saw the longest economic expansion in India from 2003 to 2008. If I remember correctly, the last 3 years of that phase saw 9% GDP growth rate. While it was a broad-based growth rate, it was entirely capital expenditure driven, a lot more capital expenditure driven. I think, if I'm not mistaken, we were the largest PPP projects in the world.
Correct.
Right? Now, what is interesting from a market perspective in the context of what we are talking about is the price earnings of the markets from 2003 to 2007 mid was 15 times. And it blasted off to 22, 23 times subsequently.
Sure.
And there was a late stage behavior that you saw. So the retail investors' participation in futures and options market became excessive. If I'm not mistaken, it was 1,60,000, 1,80,000 crores.
Right.
The retail IPO market, right? Reliance Power, if you remember, as a startup got 1 lakh crore valuation.
Yes.
And concept stocks started getting infinite P.
Right.
That was late stage behavior. And of course, it resulted subsequently in the 55% decline in the markets.
Right.
We were consciously only there for part of the year, but fortunately as a long short fund, we lost only 1.5% during that period, right, in rupee terms. Now, what is the parallel to the current context?
Right.
If you noticed the September-October phase of our markets last year, we started seeing the same late stage behavior of markets. IPOs getting valued crazily, retail participation at an aggressive pace, etc. But we had not even begun an economic cycle, right? So my learning from those past bubbles, whether it's Harshad Mehta, whether it is 2000 or whether it's 2008, is that when bubbles crack, they go to the other extreme of undervaluation. It's possible that we have seen a bit of a mini bubble in September, October of last year. So we must be aware and open to seeing the markets decline to a level where it can be excessively sold. So that is the common factors that I think you should watch out for as you look at this market.
Sure. So the critical difference between 2008 and now, like you correctly pointed out, is in 2008 you were at the fag end of the economic cycle.
Yes.
Right. Now, like you rightly said again, that we are still at the beginning of the economic cycle as far as India is concerned, for sure, right? So where does it really put you? And in terms of valuation, if you see, of course, 2020-21 numbers are distorted, but 2022-23 numbers don't look distorted, look more normalized, right? So where does that put us at this point in time? If you were to map in terms of a market cycle, where do you think we are?
So first, a good word on India. I mean, we are lucky to be in a country like this because this is a $3.5 trillion economy. We are going to take the mantle of the fastest growing economy in the world. We are a fairly consumption driven economy. We have a large amount of savings. Our multi-year prospects, given China plus one strategy, all of those things are extremely attractive. So our 5-year, 10-year outlook for India is fantastic. And we are, our NPA cycle is, behind us, etc. Having said that, markets and economies are going to be cyclical. Right? And they are not, there's no linear
And they
path.
can be different cycles. The market cycle could be very different from the economic cycle.
Absolutely, absolutely. And I think what we have to recognize, and I think this is a little underappreciated, that the primary driver of equity markets today is monetary policy of the central bankers of the world.
Right.
So if you step back, the first quantitative easing that took place from 2009, the central bank balance sheets were, the top 10 central bankers' balance sheets was $7 trillion.
Right.
They moved to $20 trillion pre this COVID. And to address COVID, there was another $13-14 trillion addition that has taken place.
Sure.
Right? Apart from this monetary stimulus, I think there was a large fiscal stimulus in the United States, which was also unleashed.
Correct.
I think the fiscal deficit in percentage terms was the highest since the Second World War.
Right.
So that is the kind of money that was thrown at the problem.
Right.
Now, of course, that led to a huge rise in asset valuations. There were bonds of $18 trillion which were quoting at a negative yield.
Correct.
What does that do? That again, all asset prices began to rise, including equities.
Right.
But then this has a consequence in the name of inflation. So now inflation has started creeping up, and yesterday's data in the US tells us that this inflation is broad-based and sticky.
Correct.
And which means that the central bankers are seriously behind the curve. And they will need to increase interest rates dramatically. With that being the case, there is a fear that this could trigger a recession.
Right.
Now, I think somewhere we are underappreciating the fact that global recessions can impact India as well. They can shave off a percentage or so or points of GDP in India as well.
Right.
Right? And as interest rates go up, particularly of the US, that is also a driver of interest rates globally. It is the mother market.
Right.
So there is going to be an increase in interest rates, and there is going to be a pressure on
other markets to raise rates as well.
And GDP as well.
Sure.
Right? So those two are not necessarily good cocktails for the equity markets.
Sure.
Right?
Sure.
And as we step back, you look at our valuations. Our valuations probably are at 17.5 times financial year 24 earnings. Right? And like I said, the mean price earnings for India is about 15.
Right.
So given that context, even if 17.5 were to revert to 15, that's a 15% downside, which is quite possible in the Indian markets. So I think the risks are front-ended and they are here and now. We'll have to see how this evolves, but my sense is the prognosis at this moment is not looking pleasant.
Sure. So the counter argument to that is that so far, from 2000, the response to the 2008, so from 2009 till now, central banks, except for a brief period in 2013, probably the central banks tested waters with the market, which didn't go really well. So largely they have been super accommodative about the markets. It's like, one eye on the market, sometimes both eyes on the market, right? So that is what probably causes markets to also be stay in denial. Even in the US, if you see, compared to the size of the problem, the response has been really muted.
Right.
So who is to say that although there is a huge beast in the room, which is inflation, that central banks will really walk the talk as they have been saying? And is there a risk to this assessment that central banks will act on the problem as opposed to deferring the problem, which will have long-term consequences, but maybe it won't lead to a precipitous fall?
So it's too early to even take that view, right? See, this is impacting real wages. Inflation is affecting, while wages are going up and unemployment is at a record low, it is hurting the poor even more. And there is political support today to make sure that this inflation problem is nipped at the bud. The longer central bankers, like in the US, wait for against raising these rates, the greater will be the challenge of inflation as you move forward, because it's far more stickier. So they don't want to take that risk. So for the first time, whatever they were hoping for inflation to come, it's now here. And it's broad basing, and there are second derivative effects of that as well. So my sense is it's too early to take that view that they will turn very quickly. I think there are a series of, so like I said, the risks are front-ended, because you are quite certain that they will move in that direction in the shorter term at least. But eventually, I think you're going to be right.
So one more point that which I see is not on the table in any discussion table at all, is the wealth effect of the Robin Hood investors, or what has happened over the last 2 years in the market. And it is whether it is the retail investor or a pension fund or any institutional fund, everybody has put in a huge amount of money, whether it's tech stocks or other stocks. So there is also a huge wealth effect to contend with when you see that you're raising interest rates, markets fall. That itself is a dampener for consumption. So again, from the central bank's point of view or the government's point of view, is that not a large enough counterforce to really take a more neutral, accommodative stance?
Again, I would say that's too early. The last time I checked, there was $2.5 trillion of consumer balance sheets, right? And like I said, wages are, there is 1 crore job listings in the United States. They're looking for 1 crore people, right? So the labor market is it's extremely tight, and rents are going up. Right. So all of this is sticky inflation. And the consumption, it's actually the reverse. Because the consumer balance sheets are so strong that they are able to absorb higher oil prices, which is abetting inflation. So like I said, I think these problems are too early. And my sense is it'll have to run its course. The Fed will have to inevitably increase rates. In fact, I would say that it's possible that the Fed may increase rates higher than the 50 basis points that they have promised.
Sure. And is there a trigger? Like, of course, the markets are really, the fall is really accelerated, especially in the last 1 week. In India also, now today you see the markets. Is there any point, do you see a crash like we saw in 2008 or 2000, where you could have very serious cuts in a day or two or within a week? Do you see that kind of stuff panning out?
So I think the catalyst for the Indian markets was the RBI hike in interest rates. Until that time, there were two views on the market, right? The FII view and the domestic investor view. So FII view was very clear that the valuations are too expensive and India is not accounting for the risks that are emerging. The DII view was a little more benign, that these inflation challenges and growth challenges are an American or a European problem. It is not going to impact us as much. There is rarely decoupling. All these concepts of decoupling keep coming up again and again, but there is rarely a decoupling. So my sense is the catalyst has only come now. And that's why there has been a change in the mind of the market. And that's why you're seeing this rapid decline, because now there is agreement. No, these are also issues that we have to contend with. So is there I can't tell you the pace of decline, but the front end is not looking pleasant.
What is your view on the domestic flows? So far, obviously, domestic flows have been a huge counterforce to the foreign investor selling. Is that something you think will continue, because large proportion of it is SIPs, but a large proportion is also direct investors into equities? How do you see that playing out?
So I think one of the best things that has happened to the Indian investors is that they have understood the concept of SIP. And that is a good investment principle to keep in mind as to how to approach equity markets. So the mutual funds have done a phenomenal job out of educating the investor. So having said that, I think liquidity is going to be tightened. We had good liquidity in the Indian markets, and liquidity is going to be tightened, as you move forward. And given the fall and the challenges that you will see, you are already seeing that catalyst of stock prices declining. So it's quite possible that some domestic investors will take a shorter term view of the market declines and also exit or reduce their positions. So my sense is that catalyst is there. Like I pointed out, I think the RBI hiking rates was the much needed catalyst for the domestic markets to wake up, that these problems are not only a global phenomena, and we also can face the brunt of a global slowdown or global inflation.
Right. When do you see all of these pressures and risks really getting resolved? I mean, is it 3 to 6 months, or do you think it'll linger on for the rest of the year? How do you see it playing out?
So unfortunately, there are too many moving parts. You know, we are talking about, Europe is talking about sanctioning Russian oil. Now, India is a very, very, it's very sensitive to crude. And if oil were to go up, it will seriously damage our balance of payments, right? So we'll have to see where crude really settles, right? We'll have to really see how much inflation becomes stickier and interest rates increases take place in the developed market. So it's an evolving situation. Look, I'm in the camp of George Soros, who says, build a thesis and then take it out of your system and then start poking holes in your argument. So at this moment, the thesis seems to be that the front-ended risks are high. As things evolve, I am amenable to moving my views on either side. If the data becomes more bearish, I will gravitate towards becoming more bearish. Or if the data is encouraging, we will move to the other side. So I'm happy if the market goes up, but unfortunately, I'm just saying what we are seeing at this moment.
So is that how the portfolio is also positioned? Is it 50-50?
No, we are far more lighter. So whenever we see a catalyst for a big disproportionate downside, we bring our gross exposures down. It reduces the chance to make an error. Right. And so to that extent, we are probably at one of the lightest moments since February or March of 2020.
Okay.
If that gives you some context.
Okay. Rajesh, I identify you as a value investor and a follower of Warren Buffett, right? And his philosophy is that when the market is really fearful, bearish, it's the best time to buy. And he himself, over the last 2 years, has been sitting on cash. In the last quarter, he bought stocks worth $40 billion. It's a huge sum to deploy. When you have a bearish view like this, obviously your bias is right now towards shorting. How do you take advantage of this decline, if at all? And if at all, disproportionate opportunities come up with very outstanding valuations? Or are we even close to something like that?
So first of all, what has Warren Buffett bought? He's bought dividend yield stocks which are oil related, Chevron, right, and Occidental Petroleum. And then he's entered into one arbitrage situation, right? That's not really a call on the markets really, in fact, quite to the contrary.
But oil is, because oil is in play now.
Sure. So that's not necessarily good for the markets is what I'm saying.
Right.
And it's basically he's playing dividend yields given that oil is going to remain sticky, if that is what his view is. See, as far as India is concerned, as far as we are concerned, is there a bottoming out of news flow? Is there a bottoming out of valuation? Or is there a bottoming out of sentiment? I don't think we are at the bottom of any of these, right? Today, if you look at it, most people are still calling a bottom. That's not how bottoms happen. So my sense is it's a little early. I'll be happiest if we see a bottom very quickly, but my sense is we are some time away.
Okay, and how do you know?
Like I said, valuations, sentiment, or news flow. Today we are looking at a frightening news flow which is telling us that interest rates will have to go up significantly. That's not a bottoming out of bad news.
So you will have to see these things play out in action, and that is when you will...
Absolutely.
Okay, but markets will front end that, right? So before the action actually happens, the markets will reflect that. So you're looking for market action to happen?
Absolutely. And like I said, the problems are front ended and the catalyst has been only now. So my sense is that it will play out over some time.
Sure. So tell me a little more about your shorting strategies. How do you really size up the opportunities there, and how the rules of the game in terms of shorting?
So like I said, watch out for the escalator and then load up at that time. The second rule I would say in investing is never short for valuations alone. So a lot of shorters in America have got creamed shorting Netflix, or to some extent even shorting Tesla. People have been shorting Tesla since it was a $50 billion market cap company. Right? So never short for valuations. Third, always have a visible catalyst as to what is going to drive the stock price down. So that's again a very necessary condition. I would say those are some of the rules that you watch out for. And as far as shorting is concerned, risk management is the most important. So my learnings from hedge fund managers over periods is I've looked for mistakes. Where do people make big mistakes which cost them the firm? And I think it's risk management. So risk management is an extremely important part of the DNA of a hedge fund manager. To that extent, I would say we are, to a fault, slightly conservative in our approach.
So expand on both the risk management part, and also you were saying you shouldn't short a stock only because of valuation. So what kind of triggers do you look for there?
So you can short for valuations as long as there is a catalyst to take that valuation down.
Right. Can you explain with some examples?
So, okay, as we speak, we are in an inflationary condition. One of the themes that you would want to short is companies which don't have pricing power, right? Because your costs are going up, but if you don't have pricing power, you're going to have some contracting profits. I think the asset management business is, in that position.
Right.
The top guys are losing market share.
Right.
They are actually reducing their yields by a few basis points every year because there's enormous pressure in the industry and costs will keep going up.
Right.
And the valuations still are, I would say, in premium zone.
Right.
So that's, let's say, one example of you can find a catalyst. Today we are talking about rising interest rates, right? You want to look for...
So that is again earnings hit. So it's not valuation. So
valuation, but there's a catalyst.
Right.
Right, that the market is going to recognize this as a challenge.
Sure.
And asset management companies have equity portfolios. If you think equity portfolios are going to go down,
obviously
that's
the fee
going to
will also
add
go
to
down.
their earnings challenge.
Sure.
Right. So the second example could be, let's say, as interest rates are going up, right? You want to worry about if somebody has a long duration asset but borrows short. So let's say a housing finance company, right? Not all, but few. Who are borrowing, let's say, in the commercial paper market, but lending long.
Sure.
There could be a challenge there.
Cost of funds.
And some of these companies are trading at premium valuations.
Right.
Right. So there's another catalyst, there. So there are some. I mean, we can go on, but those are some of the catalysts. You don't want to be in a global commodity environment at this moment.
Sure.
For the moment, you're going to see a global growth coming off, and to that extent, my sense is these commodities will continue to see pressure.
Sure. Do you see any safe havens at all in the stock market? It's completely avoidable. Stay in cash. If you can't short, then at least stay in cash. Is that what you would say?
So from a very short-term perspective, I think telecom is a safe haven. Here, it's the reverse. The pricing is at the rock bottom. We have the lowest tariffs in the world, and that's moving up.
Right.
It's becoming a very consolidated market with the top two really taking up a good portion of the growth. The third player is seriously challenged.
Right.
So my sense is pricing is actually moving up, and to that extent, it may help in that business. Slightly longer term, I would say automobile is in a good spot. Not necessarily for the short term, but if you look at the two-wheeler or the commercial vehicle segment, volumes have contracted from financial year 19 to about 65% of where they were in 2019.
Right.
Which means if we go back to 100, we require a 50% growth in volumes.
Right.
And what these companies have been successfully able to do is pass on the cost hikes, which has been serious. 20 to 40% is the cost hikes that some of these automobile companies have seen, and they've been able to pass on these cost increases. So now it's a question of when volumes go up, right? And these are very profitable businesses. So my sense is even if that happens over 3 years or 4 years or 5 years, that's a double-digit growth rate in volumes. We are at this moment closer to replacement demand for some of these businesses.
Sure.
So it's difficult to call in the short term, but my sense is it could become very good opportunities over a 3 or 5 year period.
Sure. So you started off this conversation saying one of the short ideas is really technology disruption like EVs coming in. And perhaps that is the main, it is the main reason which is also keeping a cap or, making the market slightly suspicious about the longevity of earnings for two-wheelers and automobiles in general. How do you juxtapose these things?
Right.
Even if you assume that over the next, couple of years you have serious volume growth, who is to say that will actually go into the bottom line, and the ROEs of the past will be maintained, because they might still be rejigging their own balance sheet and investing more in EVs if they were to be aggressive. So in terms of growth story, there is a story. In terms of how the ROEs will pan out, it might be a different story.
So I think the incumbents in this case have phenomenal access to technology, right? And I think they know how to get this product right? And they have deep balance
Cash
sheets
flows,
also to invest in a category like this across. And that's what we are seeing. They're investing from premium electric vehicles to the bottom, right? So they have this cash flow to do this. They have a fantastic brand. Given the kind of challenges that we are seeing with electric vehicles in the recent past, you would want to stay with the brand. They have distribution. So some of the advantages are there for them. It's too early to worry that these guys will completely lose market share. My sense is that will pan out over a longer period, and it has yet to be demonstrated that they cannot have a product which can gain a respectable market share.
Sure. So you have some room or margin of safety, so to speak.
And the valuations of these companies are very, very low at this moment.
In the last 1 year, if you see, there was a lot of exuberance around, capex-led growth, all the economy-oriented stocks and all of that, housing, real estate. How does that pack really look to you? Does that look like one end of the spectrum, if you see, are like safer stocks in terms of earnings are protected and so on and so forth? And the other side, if you were to say they're supremely vulnerable, so where would you place the core economy stocks?
We are also looking forward to a credit cycle moving up, but I think for the shorter term it's being challenged. Even in capital goods, when we look at the larger companies, because that's really where our focus is, there are some capital good companies which are trading at exorbitant valuations. Some of these are multinational companies, and they are fantastic companies, but just that the valuation comfort is less.
Right.
And then you have the others. There again, the traction and the growth rate seems to be nominal, 10-12% at best. So again, these are not absolutely compelling opportunities that even if you take a 4 or 5 year view, their growth rates are going to be 25% or thereabouts.
Right.
So they are still 10-12% kind of growth opportunities.
Right.
So in that sense, we have not really found any company in this space, which can be give us a big alpha.
Sure.
There may be smaller companies, but unfortunately, that's not really in our canvas.
Sure. So if you really were to map the market, like I said, from one end to the other, what are the most vulnerable pockets you think, and what are the ones which are relatively safer?
So I would say that what we are looking to short is something that is vulnerable in terms of profits, but the market is not recognizing it, right? And my sense is that we are finding lots of opportunities.
Which are all the cases with a high level of margin pressure?
Yes.
Is that one pack?
Absolutely. Okay. Actually, margin pressure is all across, and my sense is that as you move forward, if the economy does slow down, I think some of the even companies with the ability to pass on prices will see demand hits, right? So they will restrict their ability to pass on prices and take some of the margin hits. So my sense is there's a lot of sectors that you would want to look at. Consumer electronics, consumer staples, right? All of them are very, very vulnerable because they're also quoting at extremely high valuations, right? Asset management companies,
right?
Global cyclicals,
right?
All of them are, I think, are vulnerable on the short side.
Sure. So tell us about your portfolio right now. What are your top weights? What are your biggest shorts and biggest longs?
That's a tough one. Like I've already told you the shorts, and I've also told you that my longs is a much shorter list,
right?
But as you move forward, we will, apart from telecom that we have on the long side, we will look to add, let us say, some of these sectors. Now we are, let's say, extremely optimistic about IT, but I think it is still some time because CPI inflation in the US is 8%, which means cost of employees for them also is going to become a sticky issue. Now, also we are talking about a possibility of a US recession. We don't know whether we'll get there or not, but that may dampen some of the enthusiasm. And valuations, while they have come off, are still not in the cheap zone.
Right.
So, but as they enter that cheap zone, I think IT services is a multi-year opportunity. And I think, these companies can compound double digit for multiple number of years. So these are some of the stocks that we will add as we,
Tech. So you're bullish on tech.
Absolutely.
Okay. And pharma?
There's very little representation that we have in pharma. We still are seeing challenges with the generic pricing in America. And the brand companies in India don't really trade at attractive valuations.
Tell us about some of your costliest mistakes in the past and what were really your learnings from there.
I don't even know where to start. But this is a business where you keep learning and you keep evolving. So you should be embarrassed about how you were just 3 years ago, right? So hopefully that means you're learning at an attractive pace. More recently, the mistake has been that, when the COVID crisis took place, actually the markets fell dramatically, 35 to 40%, right? We actually made some money during that period because we were short, nimble, etc. But I think the markets turned around very sharply. We were very late to participate. We were still worried about the challenges that the Indian economy would see because of COVID. We were told that we did not have as much fiscal space. The SME sector was quite squashed, and that could have led to a large amount of unemployment. We were told that vaccines are not possible in a 2-year, 3-year period. We were told that there are second and third phases of this. We were told that you have to lock down economies. Given that context, we were, of course, given that our primary dharma as a long short fund is to protect capital, we were late to participate on the upside. What I should have understood also is our price to book value at that time was as low as 2 times, which was what we were in 2008 bottom. So valuations had corrected dramatically. And there were still themes. So rather than worry so much about the top down, we could have looked at the bottom up. And there were still positive themes like pharma, like consumer staples, which were still doing well. And the valuations of those companies had also corrected. So that's my learning, that one is make sure that your top down view doesn't necessarily correct your color your bottom up view.
And any short that went terribly long, or your risk management takes care of it?
Risk management takes care of it. We absolutely make sure that never should a short hit our NAV.
So what is the rule that you apply? Is there a time period that you fix that, okay, if by this time it doesn't happen, I'll cut my position, or there is a price point or a stop loss that you watch? Or how do you define?
So we have a document for risk management, right? What positions we can have, what are our stop losses, etc. The rule for our document is any position that hits us by 1% of NAV, we will compulsorily remove it, right? We have never reached that position so far.
It's easy to outguess what a long investor would worry about today. But I mean, what are your worries? I mean, you're already bearish. So what is your biggest worry today?
So of course, if oil prices decline sharply, that could significantly benefit India. There is already talk of whether inflation is peaking. If the mind of the market changes to if inflation is really peaking, and you see the effect of that on interest rates, etc., we will change our view. I would be more than happy to be, to turn bullish on the markets. But those are some of the things that we would want to look at in case to change our view.
So essentially, you have to be super nimble to ensure that.
Absolutely.
But how do you gauge? Again, to gauge sentiment is one of the toughest things. So is there any parameter or anything that you look to, or is it just price action that tells you? Because most of the time, it is just hindsight that tells us that this has happened. But in terms of forecasting or predicting where it is going, how do you do that?
So there are 2 layers for us. One is the knowledge layer, and the second is the process layer. So I talked about the knowledge layer, right? But the process layer is such that in case price action does go against us, we'll just make sure that we stop losing money. So which means we may just take out our shorts. So this is an intense product. There is no question. You said nimble. Long short equity fund management is a very intense activity. So the time we start seeing things to the contrary, we will at least stop losing money and make sure that to some extent we are participating in the stocks that we like, the longs I told you about. So that's what we would do.
From here on, what is the minimum fall you expect and what is the worst case? For you, the best case?
So one thing, like I told you, like George Soros would say, keep your thesis out of your own system and keep evaluating and judging. I would be more than happy to turn bullish, but let me see some data to that effect. My sense is that, like I pointed out, we have come off a bubble, which a lot of people don't appreciate enough, which means chances are very high, and that's my judgment at this moment, that we can go to the other extreme. Given the context of what I told you, we are at 17.5 times 24 earnings. Even if we come to 15 times, that's like a 15% fall. So it's quite possible that we could see a 10 to 15% fall from here on. That's my, I would say, base plus case. I wouldn't say the worst case, but base plus case. The worst case, we'll see how it evolves.
Sure. And one final question, which is the one variable that you are watching now, the most important variable in your.
So everything is central bank policy, and I think people underappreciate this fact that everything is really central bank policy. This is not, so when we focus a lot more on EPS, so EPS multiplied by P drives market prices.
Right.
Right? But in this case, since 2020, P is the more important variable which is driving markets.
Right.
And all of that has been triggered by central bank policy.
Sure.
So that is the most important catalyst to watch out for as you move forward.
Sure. Thank you so much, Rajesh. It was such a pleasure talking to you.
Pleasure being here.